Good day, everyone, and welcome to today's webcast and conference call with IBC Advanced Alloys. I'm Jim Sims, Director of Investor and Public Relations with IBC. Joining us today is Major General Duncan Hines, United States Marine Corps retired. General Hines serves as President, CEO, and Director of IBC. Before we begin our webcast, just a few reminders. The slides from today's presentation and the audio of this call are being broadcast live on the web. A recording of the broadcast is being made, and a replay will be made available on the IBC website following the broadcast. Also, a PDF, a printable version of the presentation used in this webcast, will also be made available as a downloadable handout. After the formal presentation, you'll be able to ask questions of the company using the questions pane on your computer screen or your smart device. Simply type in your question and click send. Those of you who are connected via a listen-only conference phone line can pose your questions by emailing those to me at jim.sims, S-I-M-S, at ibcadvancedalloys.com. You can also text those to me at 303-503-6203. We may not be able to get to everyone's questions during our 1-hour webcast, but we will try to get back to everyone with answers as appropriate after the webcast. So with that, let's get started. We will be making forward-looking statements in this presentation today, and viewers are cautioned not to place undue reliance on such forward-looking information and statements. Please review our legal disclaimer here and other risk factors that we list in our quarterly and annual statements. Now, let me hand things over to IBC President and CEO, Major General Duncan Hines. General?
Thanks, Jim, and good morning to you. Welcome and good morning to our investors in the United States and Canada. Good afternoon to our investors in Europe and overseas, and a hearty welcome to our suppliers, customers, employees, and competitors who are online and listening. Let me apologize up front that I have a cough due to allergies today, and so if I cough in your ear or clear my throat, I apologize. And if there is a significant pause, it's because I've tried to mute the phone to get through a cough. So with that, let's get started. Our mission is to lead the specialty alloys business by providing precision, cost, and purpose-effective material solutions tailored to our customer specifications, while providing a positive work environment for our employees and value to our shareholders. With that, I want to update you on 4 key points in today's presentation. First, the capital improvements are indeed complete, and they are making a difference. Number 2, we are continuing to make great progress towards profitability, and I hope I can show you through the numbers and through the progress in this quarter, that trend to profitability. We had our challenges, but we are overcoming them. On a short-term basis, we are focused on execution and on meeting that profitability in Q3 or the first calendar quarter of next year. Longer term, I want to update you on our strategies to continue to build shareholder value. With that, let's look at the capital upgrades. The solution and annealing furnace, along with the quench tank, are indeed completed in terms of installation and qualification at our Franklin facility. These have helped dramatically improve repeatability and product consistency through improvement in the heat-treated properties from batch to batch. We simply get a better grain structure now. That has qualified us to meet new product specifications. And with that, those more stringent specifications, we are now seeing new orders from both current and new customers. The vacuum induction melting furnace has completed installation in the facility in Wilmington. It has demonstrated our ability to increase capacity by 25% over the same time frame. we intentionally incorporated a lot of automation into that and a lot of real-time data processing. Two important parts of that. The data now has reduced unplanned maintenance by over 80%. It has reduced our reliance on our highly skilled operators, that the operator-to-operator consistency now is much better because it's not relying on that one really good melter. And finally, it has helped us through the data collection to continue to tighten the variations that increase our yields. Additionally, at EMC, in addition to those automation and in-process monitoring upgrades, we've added digital radiography, which now allows us to reduce our cost structure over the traditional film-based system, to reduce the materials that we have to buy to process that, and to increase our throughput in order to meet both current and future throughput requirements for our aerospace components. We've added an automated tumble blaster, which now allows us to take all of our remelts and use that in an automated fashion to meet our demand for material flow for the furnace. We've upgraded our coordinate measuring machine, which now is able to do the dimensional analysis on our parts, a process we used to send out to a subcontractor. So we now see improvement in both costs and in cycle time. We've added automated parts washing stations, which both increase throughput and provide a health and safety enhancement for our employees. And finally, we've added an induction-coupled plasma machine for chemistry. Again, another process we used to send out to a subcontractor, so we see immediate savings and cycle time reduction. The simple summary is that the capital improvements are in place now and are making a difference. So it's going to point to on our continuing progress towards profitability. I want you to take away 3 key points. EMC, our Engineered Materials Division, has made the transition to rate-based manufacturing. And this has resulted in positive EBITDA now and near or positive operating income. EMC is no longer the cash drain it used to be on this company. Point number 2, we have reduced corporate costs. They are less than half what they were a year ago, and we continue to focus on cost reduction at the corporate level and each of the divisions. Point number 3, despite a tough July, copper is trending back to profitability. They are doing a great job of reducing costs, eliminating the low margin products, and are now at a good point to be able to push sales revenues back up with increased profitability. So let's go into the data to specifically look at all of these. I'll start with the key points that were made in the press release. At a consolidated basis, we had a 36% increase in sales on a year-over-year basis. We saw positive gross margins of 9% compared to minus 15% on a year-ago basis and 0 gross margins overall in FY16. Operating loss narrowed to 2 cents a share, from a minus 7 cents in the preceding quarter and a minus 5 cents on a year-ago basis. As I alluded, we did have some significant personnel issues in Q1 that we had to overcome. And as a result of that, that has delayed our goal of meeting profitability, which we will now say we are targeting in Q3. And I'll show you why I believe that. But we continue to work hard at that. Let me explain the personnel issues. We had a combination of real-life crises, injuries, and resignations, which literally took 4 of my 7 employees in a key department out for an extended period of time. That all happened in a 2-week period. we did the only thing we could do: take care of the employees and their families, shift personnel where we could regarding skill sets, go immediately out to hire new folks to be able to help us fill the gap, and just as important, close the breach as best we can. I equate this to the colonel of the regiment who, knowing that there's been a breach, picks up his rifle and runs to the front line to help close that breach. That's what Mark Worma, our president of the Franklin facility in Copper, did. He has spent an extended amount of time on the floor working with our employees to help work out the backlog. This speaks highly of the culture that we are doing in our company. Copper was able to increase sales by 7% on a year-over-year basis, but it's an 8% decline sequentially. Again, that decline is due to the labor shortages and some equipment downtime that we had in the Franklin facility. Gross margins, though, have swung to a positive 8% from a minus 2%. Average selling price is now up by 10%. Operating losses are cut by 46%. And our cost of sales now have declined by 3.6%. While our order bookings on a year-over-year basis are up by 15%, they're down by 16%. Again, this is part of the seasonality that we see, but more importantly, as I ended up delaying my ability to deliver orders that we had in July, those pushed into following months, and we were forced to decline orders or to give customers a much longer fulfillment date. And that resulted in decreased bookings. Same thing happened with backlog. On a sequential basis, we declined by 20%, and on a year-over-year basis, we declined by 10%. Let's talk about EMC. At EMC, the sales revenue are up by an astounding 142% on a year-over-year basis and 36% sequentially. Gross profits have now swung on a year-over-year basis to $175,000 from a loss of $481,000. Our margins have shifted to a positive 12% from the negative 70 on a year ago and 13 in the preceding quarters. And we have cut operating losses by 90% year over year and 84% sequentially. Again, EMC is no longer the cash drain. They are now focused on manufacturing and meeting customer commitments. EBITDA is positive, and we are now consistently delivering products to our customers. Let's look at the numbers more clearly again. I want to look at the quarter over quarter. So when you first look at the slide, you go, I'm not seeing the trend. So let me try to talk to it more specifically. There is a seasonality that occurs to it. And because of that, we see it on the quarter over quarter comparisons. So starting with Q2 of 2016 to 2017, we see a $300,000 increase in revenues and a net loss reduction of over $900,000. In the following Q3, though, the comparison is not as clear. And the reason is because we had an anomaly in Q3 of 2016 where we literally had revenue recognition for 2 quarters worth of deliveries because of the machining. We should never have been doing that machining cost. While it provided very little contribution margin, it had good revenues, but again, very little contribution margin and significant downside risk. So we've eliminated that. And that makes the comparison more significant in terms of where the revenue should have been lower in Q2 of 2016 compared to where it is in the Q3 of 2017. In Q4, what we have is the significant decrease in Q4 of 2017, primarily again due to the Houlihan Award. $1.38 million of that booking of the award was in that quarter. So again, on a year-over-year basis, we see profit loss reducing. Finally, comparing the current quarter we're just completing to the last year, over a $1 million increase in revenue, 36% under the same basis, along with over a $1 million reduction in the loss. This perspective is important as I try to show you in the next slide. If you look at the seasonality, which is shown relative to the green line across the 4 quarters, that's the slope that we achieved in 2017, but we start from a basis in Q1 of 2018 with over $1 million more revenue and a much significantly closed loss ratio. If you extend that line out to the performance in Q2, Q3, and Q4, you see why we remain focused on execution and profitability, and that it is achievable in this time frame. More importantly, not clear by the line is, we are intending to increase the slope of that line to give us greater value back to the customers. Let's go one level deeper. I'm going to take you down to the monthly performance data of each division and talk about what happened. First, EMC. August and September, clearly profitable, clearly now demonstrated. We finished up the certifications for our aerospace components in July. That was longer than we anticipated it would take, but once completed, EMC is now delivering. You see positive EBITDA, and you see in the last 2 months profitability, and we intend to be very close to or break even in the following months. On the copper side, we started with a tremendously good book going into July. But because of the personnel issues, we were unable to deliver on that. And that resulted in a not so good month. We've continued to work that backlog off in August, September, and indeed in October, and have nearly closed all that gap. As a result of that, though, we saw and needed to change our commitments and our promises to customers, which delayed some of the orders we now see in Q2. So the forecast I'm providing is based on that. I want to also remind the listeners that September, the minus 150,000 you see there in operating loss, included 130,000, which was a write-down for bad debt. We had a customer who simply rejected his delivery because it was late. Since then, though, that customer has agreed to take half of the order at full price, and if the performance of those goods are indeed good, he will take the remaining portion of the order at full price. Those directly relate to the top line in the current quarter. On the next slide, you can see that the corporate expenses are relatively under control and half of what we have been doing in the previous years. Key portions, that the share-based compensation is non-cash items. That's the compensation we pay to our directors and to some of our employees in lieu of cash. So we have reduced corporate expenses by half. Finally, on a consolidated basis, we see the terrible July. We see recovery happening in August. Again, remembering that September included the 130,000 of bad debt, we would have had positive EBITDA in that one and been very close again in September. Let's talk about the next quarters now. So our near-term focus over the next 6 months is execution. How do we deliver to our customers? They have been loyal to us. They are coming back. We need to be able to commit to make our commitments. So with that, I'm going to provide, how did we do in October? The unaudited October results are presented in this slide. Copper was profitable with EBITDA of $84,000. EMC had positive EBITDA, and although the sales number is slightly down, it is because in October we were beginning prototype melts, which are non-revenue generating, but intended to increase yield and to be able to meet new customer tests. At the corporate level, again, expenses are controlled. So on a consolidated basis, we were very close to profitability in October with positive EBITDA. So how does the rest of the quarter look? I expect EMC to continue the trend that it has established, with EBITDA remaining positive for the quarter in a range of $20,000 to $100,000, and the net profit being profitable at $20,000 down to a potential of minus $80,000. The copper division will finish EBITDA neutral to very slightly negative based on the currency. Although we had positive EBITDA in October, we still have some challenges relative to backlog, and I'm concerned about timing issues at the end of December. So EBITDA will be in the range of minus 100 to 0, with net profit loss of a minus 185 to minus 85. Corporate costs will again remain low, EBITDA to minus 160 to 110, with net loss of minus 180 to 130. So on a consolidated basis, we expect EBITDA to be very close to neutral, down to a minus 240, and overall loss to be in the range of minus 440 to minus 210. Again, closing the gap in this quarter as we continue to push sales up at the copper division. So in Q3, we are hitting the accelerator now for sales for fiscal Q3. We know that at EMC, for instance, we have approximately 5 shipments left under the current contract with our aerospace provider that will take me all the way through deliveries in Q3. Additionally, we should hear about results of bids we have made for the next contract. We also expect copper sales to grow. We are seeing some of that now, but it will grow at a slower rate than EMC. And finally, the company will turn a profit in Q3 based on our current projections. Additionally, we continue to work with customers to improve yields. At the EMC division, we were able to make changes to a current design to improve those yields, and we expect those deliveries to start in Q3. We are seeing demand pick up for the electronic manufacturing division. This one sounds almost counterintuitive because Christmas season is coming up now for delivery of those components. But remember, we're talking about the manufacturing of those goods. So the machines that have to manufacture those start their intensive cycle in our next quarter, in Q3, for delivery of components that then start to be assembled and massed for next Christmas. Finally, we put into place an employee incentive plan. This incentive plan rewards quarter-over-quarter profitability. We want to make every single employee of this company a shareholder. And we want them to be incentivized to help us grow. This incentive plan does that. So what are the risks? First, let me start with the assumptions. In Q2, you've already seen the October results, and I have 95% of the orders necessary to deliver on those numbers. In Q3, EMC still has 100% of those orders. And the copper number is based on backlog, plus historical projections that we have seen in the past, plus our probability-weighted new business initiatives on prototypes already in progress. But I want to continue, as I have done in the past, to make sure I've given you a balanced perspective. So our risks, they include the normal business competitive environment. In addition to that, we could have challenges on material availability. We have seen some spot market problems in terms of materials, but we have so far been able to go to second sources to fill those. Timing in Q2 is also a concern for me relative to revenue recognition. We could end up with product ready to deliver for revenue recognition, but we may have customers who are simply not available to be able to do those inspections. We can also have, again, more equipment breakdowns or labor issues. And of course, there are the litigation issues. We've outlined those specifically in the MD&A, and we will commit to continue to do so. Cash flow. We've looked at the cash flow balance. We have a positive differential right now between receivables and payables, but our continuing ability to produce or to purchase inventory to meet future commitments relies on our ability to collect on those current debts. And finally, our bank BMO could call the loan. Now, let me just simply say here that they remain a great partner and continuing to help us. So I'm not saying that's going to happen. It is simply a probability. Let me talk now about the long-term focus. Again, I'm going to apologize up front for having to be restrained and somewhat vague in this part of the discussion, as again, I'm sure our competitors are listening. Let me reiterate our mission. Lead the specialty alloys industry by providing precision, cost, and purpose-effective material solutions tailored to our customer specifications. Are there opportunities to combine the capabilities of both divisions? The answer is an emphatic yes. So we continue to work on our business strategies and plans that bring together our expertise in specialty metal product sales, in our foundry operations, in castings, forging and machining, and our highly specialized engineering support to our customer. In the copper division, our focus is on how do we specialize to expand while keeping our nimbleness. Let's grow our sales and engineering support to help our customers truly understand the product that we can provide and those services, and expand our ability to make final products. I talked about the electronics sector. We are producing now 4 first articles for OEMs in both the electronics as well as other business sectors. And we see a potential that those could represent significant revenue expansion in the next 12 to 24 months. We are also increasing our toll work to provide better labor and better distribution of costs at our facilities for foundries. And finally, we're working to expand our copper beryllium products. At EMC, we're getting up on rate now, but the next thing is to increase the breadth beyond our barrel cast near net castings. I want to increase our breadth in investment casting capabilities and materials. I want to start developing different beryllium aluminum offerings. And I want, as we continue to focus, to make sure we're staying ahead of technology, specifically things like 3D printing, and how can we integrate those into our core processes to increase efficiencies. At both divisions, we are going to leverage our sales and engineering assets across both divisions so we can provide that quality support to our customer. And we are looking at vertical integration into more finished parts through additional special alloy machining capabilities. On the joint venture front, I've talked about NioCorp and Scandium. Through our partnership with NioCorp, we have received sufficient amount of scandium trioxide now to proceed with the initial test melts to validate our processes. We continue, both Mark and I, to get updates from the team, and I remain optimistic and excited about this part of our business. On the acquisition front, consolidation of foundries is a priority to reduce the cost structure or to find ways to utilize those facilities better. We are planning for the next doubling of EMC's revenues, and we continue to look at opportunities of vertical integration in special alloys machining, whether that's capabilities with individual machines or whether that is other businesses that perform those that we might acquire. I hope you are as excited as I am about the long-term potential to lead the specialty alloys business. With that, let's see if there's any questions.
Thanks, General. Questions are coming in. For those of you who are on the webcast, you can pose your questions again in the questions text box, or you can send those to me. Several have come in, General, so let me just take these as they've come in. The first question is, you mentioned several potential roadblocks to profitability in Q3. What do you see as the biggest of these?
So I talked about the risk factors. I don't think there's any single one that jumps out as biggest. We are executing, and it's really about timing. So I think the books are coming, the processes are coming, and it's now up to us to execute.
Okay, here's one. What do you see for the future of scandium alloys, and are you looking at 3D printing technologies?
Well, to the latter, the answer is yes, and we always look at that, but I'm not going to speak to it specific to that material alloy. What I'm simply going to say at this time is we understand the market, and the market is there. So I want to be able to reach into the marketplace to find those early adopters, to make sure we've got the processes so we can be one of the lead contenders in this space.
Okay, here's a question. How reliant is IBC on the F-35 program and your sales there? Will foreign sales of that system be important to IBC down the road?
Well, anytime that Lockheed Martin is able to sell more airplanes, that's goodness for us. We remain one of the suppliers for parts to Lockheed Martin, so they want to preserve a competitive environment, and I respect that. Having said that, I know that the quantities are going to increase as the budget increase, and that additional overseas purchases will occur. And you can look into the budget plans for the Department of Defense to see the actual quantities. But in the 5-year plan, there is a steady increase of purchase of F-35s, as well as first purchases for Britain and other countries.
Okay, here's a question about beryllium alloys in general. What do you see as the prospects for commercial applications of beryllium alloys? Do you see more growth on the defense side of that business or on the commercial side?
Defense is an early adopter, and we've worked hard with that. But I think as we move to mainstream, as we start to drive down price point and be able to meet rate, we will see more commercial products come online. They will first come in the form of manufacturing. Why manufacturing? Simply because when I can show that through the use of our material, I can increase rate with better tolerances, i.e. I'm able to meet a higher specification and a higher rate. That's one of the beauties of our material. And at that point, cost becomes less of an issue for them because they get a distinct advantage in manufacturing. So we see manufacturers want to be able to do that. Past that, I see opportunities in high-end automotive and high-end sports. Again, it won't be mainstream to start, but there are great opportunities in high-end sound, in high-end sports, and high-end automotive, where our material can make a difference in performance.
Okay, General, here's a question. What about the product you were developing with BAE Systems? Where is that now?
It is still in test, and we're waiting to hear the results of their funding relative to how much allocated is funding has been authorized by Congress.
Okay. Here's another just came in. The company announced previously its work for a computer chip. I think they mean computer chip manufacturing, equipment manufacturing company. What is the status of the work with that customer, and is there more than one customer in that sector? I think they meant.
That is an exclusive arrangement we have with that customer, but it doesn't mean that I can't do like work. It's just not specific to that type of application. So for exclusivity, it was a minimum order contract of 4,000 parts. We will deliver over 97, close to 10,000 parts on this year. And as I mentioned, I continue to see the rate of those expanding. So if you take a look at the number of Apples and the number of iPhones and the number of memory chips being used, this is a manufacturer that does a lot of that work.
Okay, I've got one more question so far, General, is there a problem in process with scandium alloy tests, and why have the results of those tests not yet been released as previously promised?
There is no problem with the scandium process. We are continuing to validate that, and we will make an announcement when appropriate. Understand appropriate means we don't want to tip off too early what our strategy is, but I do want to update you as we make progress.
Okay, General, and that's the last of the questions we have. So with that, we'll close out our webcast today. For those of you who perhaps joined late or may have questions that you'd like to pose to the company following our webcast, just email those to me at jim.sims, S-I-M-S, at ibcadvancedalloys.com. We'll do our best to get back to you with the answers as we can. Today's webcast was recorded, and a recording replay of the webcast will be made available on the IBC website later today. Thank you all for joining us today. We look forward to seeing you soon. Have a great day, everybody.